Hi, everyone. I'm Rick Bensignor. Today is Tuesday, June 23rd, 2020, and welcome to this week's In the Know Trader Show. As we record late Tuesday morning, the S&P is having another strong up day, up almost 1% at 3147, with a high just 2 points higher. So we are basically on the highs of the day after a rough overnight session, which saw the September S&P futures get as low as 3060. They're now trading at 3137. So they are almost 70 points above the low. And of course, the overnight story was Peter Navarro saying that the deal with China was off. That sent futures tumbling. And then as the night progressed and the morning came, he backtracked on that. President Trump says the deal is completely on, and the market's up as if nothing happened. And if anything, we're seeing shorts getting squeezed out more, because otherwise there's not a heck of a lot of special news out. We've got the 10-year trading at about 72 or so basis points, so that's up a couple on the day. Oil is up again to over $41 for the August contract here in the US. And gold's having another good day too, because the dollar's getting hit. So August gold is up at 1782, up about 88 basis points on the day. Meanwhile, the dollar, where are you, Miss Dollar, on my quote board? There you are. The dollar index is down 56, well, actually about 58 basis points on the day, right near 96.5 or so. So that's given up some of the recent gains. And if I remember my chart correctly, if we got under 95, I think it's 95.21. To me, it would appear as if the bulls have lost all their edge since the secular low was made a couple years back, and I would put the bears in firm control. And of course, that should help gold too. Weaker dollar, which is something the president likes, and it's not really seen much during his presidency, but this could really open the spigot on the downside if we get under 95.21. So that's how we start off today's show. To take a look at what we're going to do, we'll do our markets overview. Today in the trader education portion, I want to talk about open interest, and I'll explain what open interest is for those of you who don't know. It is something related to the futures markets, and it's a very important thing to understand what it is and what it represents, and it gives you clues into what's really going on. And I'll show you a couple of examples of how important it is to understand and see the value of what open interest is. And we're only going to do a piece of it today because there's another whole conversation we can have about who makes up the open interest in the marketplace, but that'll be another day's conversation. And then this week, let's go back to something that we looked in, I think it was back in March was the last time we looked at gold and silver mining names. But as you know, if you're an in the know trader client, we have been bullish the sector. We're long GDX, we're long gold. So let's take a look at also some of the names, and I don't know, we probably have close to a dozen names here or so that we can look at individually, and we'll see the difference between some of the larger cap names and some of the smaller cap names that exist. So first off, to get in touch with me, it's rick@intheknowtrader.com. And of course, you should check out our website and look at some of the things that we've got there. That's intheknowtrader.com. To sign up, you click on the sign up tab, and that gets you currently the opportunity to subscribe to our weekly tactical trader report that comes out Wednesday nights. It does a solid overview across the macro marketplace. So we often look at, well, every week we look a deep dive into the S&P because that is the underlying benchmark to U.S. equity trading. But we usually also look at, let's say, the 10-year and gold, sometimes oil, sometimes the dollar. So we're looking across the major asset classes, get a sense of how they correlate with each other and what's going on. And then I also give you a new ETF trading idea each week, as well as follow up on every open idea that we have, every open ETF idea that we have on the books, as far as recommendations, whether we're still recommending something to get into that hasn't come to our price yet. I'll give you updates on that, or sometimes we move our entry price, as well as follow up on every single trade that we have on until it gets closed out. And of course, it gets closed out when we take profit or if we get stopped out. So you're never at a loss for what I'm thinking about any recommendation I've given you, because it's all followed up with each week, and you can subscribe to that. And then also, I am on the final legs of putting together this a new piece that you can subscribe to, which will be a monthly macro sector report. It'll go through the 11 SPDR ETFs that represent each one of the macro sectors of the market. And what are the macro sectors? You know, it's the financials, healthcare, industrials, real estate, technology, and so on. So what we're going to do there is tell you which one of those SPDR ETFs you need to be in, is invested on the long side, and which ones you don't need to be in. And if you're, all you have to do is be in the good ones, the ones that, and what makes them good, they outperform the S&P. Stay away from the ones that underperform the S&P, and you will beat the results of the S&P. So that is our goal. I will have more details in the coming week, to hopefully no more than 2 weeks, and get this thing launched in early July. Okay, let's take a look at sectors week over week. So here's those same 11 sectors. On the right-hand side is year-to-date through yesterday's close. On the left-hand side is year-to-date through a week ago. So what we compare is week over week. We like to see what's moving in the marketplace. Green dots underneath or above the bars means that they have moved at least 1% higher versus the S&P in the prior week. Red dot means it's lost at least 1% in relative terms. So this week we only have 5 sectors that have changed enough to at least warrant taking a look at. The first is on the left-hand side, consumer discretionary, picked up over 1%. It was up 5.4% last week. It's now up 6.6%. So it's still an outperformer. You can see there are 4 outperformers this year, the best one being technology, which is up 17.2%. Last week it was only up 14.10%. So this picked up over 300 basis points of performance in the last week. In fact, it's the biggest moving SPDR ETF in the last week in relative performance terms, and that's why it has the bigger green dot. So out of all the sectors that moved in the past week, more than 1%, technology was the biggest gainer. You see that healthcare picked up a couple of percent. It was only up about 0.5% last week. On the year, it's now up 2.5%. So that picked up 200 basis points. And then we had a couple of losses over the course of the week. Utilities lost about almost right around 2%. And then real estate also lost over 2%, so not a good week for them. And you can see now that usually we don't, like over the course of the year, you're going to have a lot of sectors of the 11 that are close to, and I'd say when I say close to, it's probably within 5% of performance on either side of the S&P. And those are somewhat neutral. The real game here, and this is the game that every long-only portfolio manager, every person who's running a mutual fund that's, let's say, benchmarked to the S&P, that essentially needs to be fully invested at all times, other than having maybe a little cash on hand for redemptions. Their game is to pick the winners, the outperformers, and to shift their allocations between each one of these sectors depending upon how they think the sector is going to do versus the S&P. If everything was in line with the S&P, then you couldn't really outperform, and the whole thing was you'd buy SPDRs and you'd never believe in active management. And there's a case for passive management because it's tough to outperform year after year after year and be in the right sectors. But here you can see that there are only 4 of 11 that are outperformers. And if we take out healthcare, because it's not even up 5% versus the S&P, you really only have 3 sectors that are above 5% performance. Of course, tech being the runaway, as it was last year. And on the downside, energy still getting crushed as it was last year, but much better off than it had been earlier this year. But it remains the complete dog sector of the marketplace. This year, financials are the second worst performer. And, with interest rates being low, we talked about this for the last few weeks, banks can't make a lot of money when the spread between the long end of the curve, so let's say 10 years and out, and the short end of the curve is not steep. And if the short end of the curve is at 0% and the 10 years trading at about 72 basis points, they can't make a lot of money on that spread. Banks love to see low short end rates and high long end rates, because then they can really make big profits. And you can see that financials are really getting knocked. They're underperforming 16% or 18% this year. Versus the S&P, simply because banks don't do well when the spread between the short end and the long end is as narrow as it is. So if you think the long end is going to go up significantly relative to the short end, then you buy financials down here, and you look for them to make up a lot of the lost performance. If you think we're going to stay in a low interest rate environment, both on the short and the long end of the curve, then banks are not the place to be. And I think it was either last week or the week before, we did this podcast and focused on financials and talked about that. I just don't see a heck of a lot of good upside in the bank stocks right now, using the models we do and the charts that we look at. Most of them were neutral to heavy. There are a couple of standout names, but otherwise they have tremendous overhead resistance, and seemingly not the great place to be. And you can tell that just simply by the relative performance to the S&P. All right, now let's take a look at the markets through some charts. So let's get to. Here we go. So let's start off with the S&P, like we do most weeks. And again, this is just a basic weekly chart of the S&P, whereby we have this pink colored section, right, kind of right where we're trading now. And that's up in here. That for months, I've recommended that if we got up into this range, you'd want to do some selling and reduce overall long exposure in your book. With my belief that the all-time highs that we saw early in February this year are going to stay the all-time highs for the balance of the year. And that if we got a pullback down, sub 2650 or something into that range, you'd want to do some real significant buying, on my assumption also that we will not take out the lows that were made in March this year. So we've been here into this area for a month now, and it would be interesting to see if we continue to trade up on the week like we are, and whether or not we close above this, we'll call it, I guess, a brown colored dashed trend line, which had connected this all-time high to the next all-time high to the next all-time high. So, we have a line that had only had one prior close above there, just before the week that made the recovery high. And if we start getting above here, I'm not going to love it that we've come up there again, but I'm thinking that we probably can use the reference high of 32.33 as a level that should pose resistance. And I don't even mind if we test it or minimally exceed it, and then come right back into the range. If we exceed it and don't come back, then I'll probably be proven wrong, and then maybe this market just keeps going and does end up taking out the high. I will say that markets can act irrationally a lot longer than people's pocketbooks can usually last. So one also need not be stubborn in their assumptions, because like anything else, the market will either prove you right or wrong. And if it proves you wrong, generally you need to adjust what you're thinking. rather than end up being very stubborn. So again, I don't mind. I'm happy to have sold into this range north of 3,000, and I'm willing to bide my time. I don't see a heck of a lot good going on out there at all. Um, and I see states opening, and of course you're getting higher COVID cases, and a lot of it is because of testing is getting much more thorough and rampant now. So of course we're seeing more cases because people are getting tested finally. So I understand that. At the same time, we're clearly getting a lot more cases, and states that are aggressively opening, like Florida, like Texas, like Arizona, are seeing some big spikes, and I can't see how that's a good thing. I don't see the corporate profits particularly being very good, and I'm still concerned in a general sense about the market, but I certainly can be proven wrong, and if so, I'll make adjustments. So that's a look there. Let's just quickly look at a couple other things, and well, the 10-year, really nothing going on, so we don't need to look there. So let's look at gold. And I'm going to look at gold for two reasons, because this will lead us into our discussion about open interest. But right now you can see gold is very strong. We're trading at about 1781 or so in the August contract, which is the front month futures contract. This is a rolling futures chart going all the way back to 2002. Here's your all-time high at 1926, 1924, looks like, for the active front month contract. And so you can see there were some prior highs here after we made, and this is a monthly chart, so after we made the all-time highs and we bounced back, you can see a high here at 1804.40. This one is 1792.70, and these in here are 1798. So if you can get through 1804, my guess is this all-time high doesn't stop us. So I like gold. We're long gold. We're long gold names. We're long gold, the actual bullion, and I like the sector. Now let's talk a minute about open interest. What is open interest? Open interest is a tally of how many futures contracts are committed to in the futures markets for each month. So let's look. For gold, this is total open interest. So this is saying that as of now, there are 500, this would be through a day and a half ago or so, noon New York time each day, updates with a preliminary figure from the prior day, and then it gets, I believe after the close, they give you the final tally. So look, you can see here in blue, there's approximately 523,000 contracts committed in the gold market, which means because that futures contracts are a zero-sum game, there is a long for every short in the futures markets. That is not the same in the equity market. You can go long a stock. It doesn't mean that somebody is on the short side of that trade. But in futures markets, because a new futures contract simply gets created by somebody wanting to buy from somebody who's willing to sell, every single contract is a combination of a long and a short. So down here in this blue colored line on the bottom part of the chart is the open interest in gold over time. And you can see that early in 2020, it spiked up to a level that's been as high as it's been in 20 years. And for all I know, it's probably the all-time high. Let's see. I would think it is. Let's even go back to, oh, well, I don't have open interest figures from 1980. But certainly it's the highest level in approximately 30 years. And then open interest came off, and now recently we've seen it started turning up. So let's quickly take a look at how does open interest change. If I decide, if I'm buying gold, let's say for a new commitment, I want to go long gold, and I buy it in the market, and even though I don't know who's on the other side of my trade, the clearinghouses do. So in other words, the brokerage firms who then clear the trades, they know who's on the other side of a trade. If I go long when somebody wants to go short, we're both adding to open interest. So if I buy one contract of August gold to get long and somebody sells me a contract of August gold to get short because they think it's going down, open interest has moved up by one contract. If I bought 10 and somebody sold 10 and I bought 10 new long contracts to go long and somebody sold me 10 to go short, then open interest moves up by 10 contracts. So right now, there are approximately 523,000 commitments in the gold market, which means there are 523,000 longs, not long individuals, but contracts on the long side, and 523,000 contracts on the short side. It has to be that way in futures. There is a long for every short. So if I go newly long and somebody goes newly short, we've both added to the open interest. Let's look at number 2 here. Open interest stays the same if, let's say, I go long and the seller was somebody who was previously long and they're getting out now. So they're selling out of their long. Well, that doesn't change open interest because you didn't get new commitments both ways coming in. It was somebody who was already long getting out. So if I go long now and the person I buy from is getting out of their long that they had bought previously, open interest doesn't change. Let's go to number 3. Open interest doesn't change if a new short sells to an old short getting out. Well, if an old short is getting out, they're a buyer. So if a new short is selling to an old short covering, the old short covering buy is not a new commitment to the market. They're actually walking away from the market, right? The short is getting out. But my new short is coming in. So a person coming in versus somebody who is getting out to get out of something they had previously been in does not change open interest. And then lastly, open interest goes down if both parties are getting out of previous commitments. So if an old long, somebody who is bullish, is getting out, which means they're a seller, to somebody who had been short, who's now buying to get out of their short, both sides of that trade are seeing people exit their commitments to the market, and therefore open interest goes down. So when open interest moves up and the market moves up, that means buyers, new longs are coming in versus new shorts. If the market's moving up, the new longs are making money. The new shorts who sold it to them are losing money. So the shorts are losing. So in a good, strong market, you want to see open interest move up along with the market moving up. That means the bulls are in control. If, let's look here, open interest fell from 600,000 to 400,000, huge decline in this move where the market moved up, but open interest went down. Well, what's that mean? If open interest goes down, it means prior longs are selling out to shorts who are paying up and taking losses to get out. That's what that means. So this move here was more of a short squeeze than it was new buyers coming in saying, I love gold. The buyers were actually shorts who were losing money, or shorts from previous higher levels that made money, but they are now getting out thinking that the market will no longer go down. And they are buying it from prior longs. Now, if the longs came in recently and got out, they've made a little money. If the longs were from up in here, then they've taken a loss, but they don't think gold's going to go up much more from that point. So looking at open interest can be really helpful. And I want to show you, and I know we're starting to run out of time, so we may not get to a lot of the gold names, but I think this is really important to understand. Let's take a look at crude oil. Crude oil has had this spectacular run. This is the active chart. So it's not going to show the minus numbers because when that April, I think it was the April or the April contract was expiring, it was no longer the active contract. So the front month contract at the time got as low as, I don't know, somewhere around $7 or so. And it's had a spectacular run up to 41 where it is right now. But take a look at what open interest has been doing on this entire run, declining. This is hugely valuable in understanding that the entire run in oil, or almost all of it, is short covering. It's not authentic new buying. So yesterday when the Wall Street Journal, I think it was yesterday, or the day before, I know I just read it in the last day or two, had a article about the demand in oil is soaring. It's not. The price is going up, yes. The demand for oil is simply futures traders who were short, thinking that, again, these expirations were going to cause massive dislocations and negative numbers, and funds were hugely short the market. And what this move shows you, based upon what the open interest has done, is that as the short buys to get out of their short commitment, a prior long is getting out to get out of their long commitment. And you can see that this has gone from almost 2.4 million open interest down to 2 million. Huge difference. And so this move is not about a huge demand for oil as it is a huge demand for oil contracts. And realize how much speculative trading gets done in the futures markets. A huge amount of what's being done every single day is speculation. So I look at this as, sure, the price of oil has moved up, and if you could have anticipated this, you made a fortune. But this does not necessarily in any way mean that there is huge demand for oil itself as compared to huge demand for oil contracts, because shorts are getting out, and they're getting out to longs, prior longs, who are getting out. And we know that because, bing, open interest keeps falling. So the commitments keep disappearing to the market as people who have lost money, most likely lost money, because if you're short from up here, I can't imagine you didn't cover down in here. So my guess is, it's shorts who came in April and May who keep having to pay up to get out, and the people who bought it down in here are very, very willing sellers up here. And it's now, you can start looking at technical analysis and other things for where there's this gap fill and so on. But this tells you that the demand for WTI oil is more a function of futures players than it is actual demand for oil itself. Lastly, just one thing you need to know, in a contract like this, which every month there's a new contract, you often will see a decline in open interest as you go into expiration. So not every bit of this is some people, almost all of it is people getting out, but there's also contracts that get rolled over. So let's say you still wanted to stay short oil. Well, you don't want to be short oil into August. July expiration just happened a day or two ago. But let's use the current August contract. You don't want to be short oil as a speculator into the delivery process, because that would mean that you actually have to come up with the oil to give to the person who's on the long side of the contract. So you might say, I still think oil's going down, so you buy back your August and you'll sell September against it. So if you do that, open interest may or may not change depending upon who's on the other side. So it's not strange to see some of these pullbacks during the expiration in the middle of the month when the next month contract expires. But when you see a move like this big multi-month type down move shows you that this whole up move, shorts getting squeezed and the longs taking their profits to it. So look, I've done it again. We didn't get to any of the stocks this week, which means next week we will start off before any trading education is done, we will start off with the gold and silver stocks. That's it for this week. I'm Rick Bensignor. Thanks for watching In the Know Trader.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.